Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I obviously have threw some, not really predictions, just numbers out there based off of if the gold to oil ratio were to compress to, I would say, expensive levels from very undervalued levels. The one thing you need to do is you need to figure out where we are in terms of how expensive commodities or an asset is. Um, in this clip, I'm going to go over I'm going back into time and looking at some of the articles that were basically put out in the early 2000s, late 90s about oil. So you guys can see what it was like to go through that oil bull market and what people were posting. And these clips, like some of the stuff I got, it's not like an entirety, it's just little snippets from things. And most of them, no one would have predicted $150 a barrel oil or 145 or whatever it topped out at. No one would have predicted that. And most of them were completely bearish in 98 and 99. They're saying it's probably going to go lower. It's probably going to do whatever. But guess what? The ratios didn't lie. The ratios are an objective way to evaluate an asset against other assets. We know that they had a huge real estate boom from the late 90s till 2008. This is just a repeat of what's going on in the real estate market, and it's all liquidity driven. Liquidity and inflation. We've got a bunch of inflation. It's going to push oil prices far higher than what most people think. And I was reading all these projections and predictions and on oil back in the 1990s, and they said that oil was going to remain at $25 a barrel all the way to 2025. Obviously a lot of the people that I was reading, I can't even like relate with them in a lot of these articles because they look at the supply demand and that is it. And it's like, guys, inflation's going to rip this thing through. I mean, look at the dollar. Look at the value of the dollar. It's gone down like 90 something percent ever since we went off the gold standard. And the dollar is going to get absolutely smoked. This is an inflation driven price that is in there. And I think we're going to compress the ratio. So the whole curve shifts up from inflation, which we have inflation worldwide massively. I don't know why people don't acknowledge that. And then we're going to see the ratio compress massively. We were coming off of a bottom that was never seen in history. We went all the way to like 90 to 100 barrels to 1 ounce of gold. So let me go over some stuff. I'm going to read some things, and you guys can kind of make your own thing. I've got the oil price here on the right. So I'm going to zoom in here. It says, since late November, oil prices have fallen back significantly, reflecting both the slowing of global economic activity, which to some degree, of course, itself reflects higher oil prices, and the impact of recent OPEC production increases, resulting in a rising level of stocks. As of December 20th in the year 2000, the fund's reference price had fallen back to just over $22 a barrel. While future markets suggest that the average price of oil in 2001 will be just under $24 a barrel, only $1 higher than the original WEO baseline. While oil prices remain highly volatile, if this decline is sustained and recent spike in oil prices would be shorter-lived, then assumed in the discussion below, and the resulting impact on growth and inflation would be correspondingly less severe. So they think, this article, when I was reading it, and I just grabbed some snippets from it, they thought that the oil price going up would destroy the economy. And that price was at like $20 a barrel in the year 2000. And the article was the impact of higher oil prices on the global economy. So they thought that every $5 increase in oil prices would just completely destroy the global economy in the year 2000. Here it says, of that same article, it says the current market conditions and the near-term outlook for oil reflect the interplay of production, stocks, and consumption. Over the past 2 years, global economic growth has greatly strengthened from a rate of 2.6% in 1998 to 3.4% in 99, and to an estimated 4.7% in 2000. As a result, the growth in global oil consumption increased from 0.6% to 1.6% in 99, before moderating somewhat this year due to the sharp oil price increase. So they're saying it was moderating in the year 2000. Permanent $5 per barrel increase in price of oil alternative scenarios. They put all this huge negative connotation around an increase in the price of oil. The conclusions and policy implications in the 2000s, this is what they said. It says, for much of the period since the October 2000 World Economic Outlook was completed, oil prices have averaged $5 per barrel higher than assumed in that exercise. A sustained oil price increase of that size would imply a permanent transfer of about 0.25% of GDP from global oil importers to oil exporters. Relative to the WEO baseline, with additional transfers of income from oil consumers to oil producers within countries, such a terms of trade shock would affect the global economy through supply and demand effects, as well as via second-round effects on inflation. For example, through higher wage claims, this in turn would affect the extent to which central banks raise interest rates to offset inflationary pressures, and therefore the impact of the oil price increase on real activity. The impact on asset prices and financial markets would provide additional channels. So they thought that this increase in oil prices would completely destroy the demand for oil and would destroy the economy. And that was in the year 2000. Looking at the price in the year 2000, this is where we were at in the year 2000 in here. And they thought, well, this is going to be a impact on oil prices, and that oil prices could potentially go down, and that it was not sustained. And here it is from the year 2000. Let me just zoom out a little bit. From the year 2000, we went from like 20 something dollars all the way to 150 in like a straight shot. It's when I was reading all these articles, and I was going into a bunch of different articles, it was like, I mean, obviously it's 2020 looking backwards, but if you looked at the ratios, you just laugh at it. You laugh at it because all these people had no idea what the price of oil was going to be. And if you looked at some of the statistics about people predicting, like the IEA, they weren't even within like 50% of the price the majority of the time. Like they couldn't even predict anything. It was like completely worthless reading any of their projections because they were so far off. And I'm reading this stuff, and it's like everyone was far too conservative, way too conservative. And they were not, in my opinion, they were not tackling the inflation aspect. And it went from a price of like $10 a barrel all the way to 150, a 15x. So we went from the largest imbalance of oil in terms of a ratio of one ounce gold to 90 to 100 barrels of oil. It went negative. That screwed up the entire oil market from a supply demand perspective. We're going way higher. And they're going to throw an inflation mix in this soup that we've got. A bunch of inflation. And oil's very sensitive to inflation. So it's going to rocket higher. So I've got obviously a lot more behind me. Let's go over it. What we've got here is this is the gold to oil ratio. Here's the gold to oil ratio. And what you saw in the 97 is we were all the way up at around 28, 1 ounce gold, 28 barrels of oil in 98. That was our buy signal for commodities. And I'm just going to scroll down and show you that. Right here is the 98 buy signal for the commodity price index to Dow Jones Industrial Average. Whenever you get down here, you don't question, you don't read articles, you just buy commodities because they're so cheap in relationship. And every time in history, we've had these massive booms afterwards. What makes you think that this time is different? Why is this time different? And to be honest, if you look at this consolidation, and I'm just going to throw some stuff in here, all right? And why I think this is going to be the largest commodity bull market ever is look at this. You can throw this down like this. You throw this here. And what do we have? We have a gigantic wedge pattern. And if I were to put some stuff in here of what we know about technical analysis, 1, 2, 3, there are your responses of this ratio. Guys, this is going to be ridiculous. This is going to go like this, back test, and run. And you're going to see some massive move in commodities because we are going to be short commodities over this time frame. That's my opinion. This one, we already did the first move and broke the downtrend of the S&P 500 S&P 500 to commodity ratio. We are basically like right here, ready to like launch to much higher. Well, I won't say we're right there. I'll take that back. We'll take a look at it. I'll show you what that is in another clip. But this is a 1, 2, 3 scenario, and then we go and we break to the upside, and we have a massive move in a very long commodity bull market, is my opinion. So let's go back. Let's see what we've got for the ratio. The ratio went from a 1 to 28 back in 1998, which was a buy signal of the commodity to stock ratio. All that money started flowing into commodities, and it went all the way down to a 1 to 8 ratio very quickly in the year 2000. It bounced higher, but we still had the same market conditions for the real estate expansion phase. And then we got driven all the way back down in 05, and it even went down again in 08. This one would have been a hard one to ride long because it bounced a few times off of expensive levels of oil. So it would have been a little bit more difficult to ride. And then looking at some more, it says experts upgrade 2001 oil price forecast to 23.45 in the year 2000. In 2001, this was probably the price of oil, and then it launched higher. These guys were predicting 23.45. Here's economic growth. The AEO 2003 forecast period has been extended through 2025. Through 2020, the macroeconomic forecast is similar to 2003 forecast for the same period. From 2001 to 2020, real gross domestic product growth of 3.1% per year. And this is their estimates on the right here from 2000 to 2025 and $2001 per barrel. Their forecast is $28.35, $23.25, $24, $24, $25, and $26 in 2025. And all these other guys, they have around $20. They've got the price of oil declining to $17 in 2015. $20, I mean, 24, 32, 19, 23, 22, $21 in 2010. 2008, it was over $149 or $145 in 2008. And they're predicting 20-something dollar oil. They're taking the old paradigm and projecting it forward, even though we went into an inflationary cycle in an expansion phase of real estate. That is exactly what you don't want to do. OPEC disappoints, oil slides. This was November 30th, 1998. Prices decline as OPEC meeting, mild conditions, glut, add to some of the gloom. Here's the crude oil prices back in the 90s. Economist article, we may be heading for $5 in the 99 timeframe. Well, you should have been buying all through this area in 98, 99 with a buy signal of the commodity to stock ratio throwing a buy signal. And all you had to do was hold on all the way up as we were in an expansionary phase of real estate and ridden it to the end of that expansionary phase. And if you had done that, you'd be retired now with many, many millions of dollars. Oil prospects in the near term. However, other analysts said bulging oil inventories, a mild winter, and a divided OPEC could push prices even lower with no immediate reversal to the slump in sight. That is what you have to buy. That is what the ratio is telling you to buy. These are the articles telling you that there's going to be no immediate reversal to the slump in sight. There's no fear of supply shortages whatsoever. There's nothing out there giving the slightest hint that the supply and demand balance could tighten in the near term. Traders are hard-pressed to find any good news in the oil market. Inventories are high, and a mild fall season in the United States has dampened demand, analysts said. It's a buyer's market. Analysts said only cold Arctic air moving into the northeastern United States would spur demand for heating oil, or a major supply disruption could pull oil prices out of basement levels. And that's the article from 1998. In 1998, this is what they were telling you at the bottom of the market. Buying oil stocks is a risky business. Deciding whether to invest in oil, given the price battering, requires a view to the long term. I wouldn't buy the oil stocks based on today's conditions. I mean, there should be some anticipation. My feeling has been that there's simply too much despair about oil prices. But he added, I think the price of oil is going to recover to the high teens, and on the basis of high teens, you get much more robust earnings. And I think the stocks should be selling at a market multiple. So I think on fundamentals, based on my scenario of an improved recovery, you can make a good case for owning these stocks. And that was back in 1998. That's from the same article as this one up here. And that's when the price of 98 was the lowest it ever was. In 98 and 99 is when you should have been buying. And then it came on up and continued to go up during that expansion phase of real estate. Here's the oil price prediction, December 2012 through June 2016. They thought that it was going to collapse to $50, and then it was going to rebound 59, 82, and 85. In 2014, 2015, what did it do? 2014, 2015, that was the decline, and it came back up. And actually, that was a pretty good prediction. It was probably around $85 or something in that time frame. So the bullish case was actually the one that was right, these bullish cases. And obviously, we went over the commodity price index Dow Jones. And I still can't believe that we've got a 1, 2, 3 setup in this ratio. And then it's probably going to have this gigantic break as it comes to the corner and breaks out of it. That's awesome that I'm seeing that there. So what I'm trying to do is I'm trying to say that a lot of people, they have no idea what the price of oil is going to be. Your best indication is the ratio. Because what it does is it takes all the opinions out. It takes all the mumbo jumbo of opinions that people have, and it just throws them out the window. I bought oil at the bottom because the ratio was so cheap. The ratios, in all honesty, have never failed me. They've never failed. Yes, you could be in a asset for a while, and it could stay there and be cheap for a while. It could be a couple years, and that's exactly what you want if you're an accumulator of an asset. You want to be able to accumulate and accumulate and accumulate for a couple years, and then it just takes off and goes. So your opportunity cost, yeah, you might be stuck in an asset for a year or two, but who cares? The rewards are so big, it doesn't matter. I mean, what are we trying to do? Get 40, 50% rewards, 100% rewards? No, I'm going after 100 baggers. 100 baggers change your life, and it'll do it if you can do it, your time frame is a 5 to 10 year period. If you can get 100 times your money in a 5 to 10 year period, and I'm not talking your entire portfolio, I'm talking about some of the pieces within your portfolio can get that. It's going to change your entire portfolio. And you could get 20 baggers, 30 baggers, they're all over the place. And I know it sounds like, oh, it's just 20, 30 baggers, so easy, just hold 5 to 10 years. It actually is that easy. It really is. All you have to do is you have to do the opposite of everyone else. Just do the opposite. Don't listen to people. Go to these ratios and use them. Here's the thing. I've got the oil. This is the gold to oil ratio. Every time it's hit 30, tell me, just by looking at this ratio, I'm going to move this over a little bit and I'll come in here. All right. By looking at that ratio right to my left here, where every time it hit 30, tell me how much higher did it go above 30 outside of the one anomaly that I bought in 2020. How many times did it go above 30? Like none? And has it always recovered every single time in history since 1973, since all the way back in the early 1900s? It's always recovered and come back down every single time. Now, the time frame, don't know. You know, some of them, it remained elevated during some periods because we were in a recovery phase of real estate during some of those time frames. Other time frames, if you can get the market conditions somewhat right, it comes back down. So why are we so worried? We are at the ratio right now, I think it's at 28 or 26, a super cheap level. Oil is incredibly cheap at the price it's at today. It is stupid cheap. It's like buying oil in 1999. And in 1999, because it seems like people can't fathom the price movements. In 99, I think it was in the teens. It was like $18, $13. So today is like buying oil in 1999 at $13. Is $13 expensive? Inflation adjusted? Because that's what inflation adjusted is. Inflation adjusted oil today is $13 in 1999. Because that's what the ratio is. And the ratio is what adjusts everything. You don't use their adjusted numbers. They're garbage. They're lies. The CPI is a complete lie. They're printing far more money. So what we're doing is we're indexing the oil price in relationship to the money supply. And gold is cheap. Gold is cheap. This has so much upside, it's ridiculous, in my opinion. And almost all of the people that were projecting forward got it wrong. Almost everybody. So, you know what? I'm going to be on the bullish side, and maybe the bullish side is actually the baseline, like the base case. It's the best fit to move. And even if you were to throw some like just simple trend lines in here, you just throw some simple trend lines in here. I mean, we're coming on up. This was like a blowout bottom here, which, I mean, if you could have bought that bottom down here, I mean, you're killing it, or even up here. And this is going to go all the way back to the top here, and it's far above. If this is $100 here, here's $100. That's $100 right there. This is going to blow past this. It's probably going to go to the top side. It's going to be a few $100s a barrel. That's my guess. And that's just history repeating itself. That's the 70s going to the top of it, and then the 70s. And then you've got the pullback. You've got the 2000 to 2008, and then you've got the pullback. And then you're going to have this that goes on up. There it is. That's your channel that you're going in. And you're probably going to hit the upside of this channel. Where does this correlate with price? It's correlating. If this is 100 and this is 1,000, and we're about midway between it, it's probably a $400 or $500 oil price if we hit it right at that time. That's my guess. And that ratio were to go back down to a 1-to-6, 1-to-8 ratio, with oil at 3,000 or something like that. So that's how I view this stuff. And I know, I don't know. I can't see it going and just fizzling out. We're in an expansion phase of real estate. All the market conditions are prime. They are prime, baby. Even the commodity to stock ratio is prime. All the money's going to flow. A lot of this money is going to flow back over, and it's not going to be pretty. But I'll end it there, guys. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.